So a world in distress, that's what we're pretty much looking at here. They're calling it the new normal with a shift towards the east from the west. What's your perspective on this new normal?
It is a new normal, but the shift is not without problems. The West, we know Europe is struggling, and you can't count on it really for economic growth, over the next while, an investment horizon of a year to 2 years. America is trying to break through its debt ceilings as well, and there too one will be a little cautious to look for too much growth. And so one typically would eye India and China as the growth stories. But they too are not without, this is not just a given fact, they too have their own inherent problems. And the first one that would come to mind is something like inflation. Many people might not be aware from a South African point of view, but inflation is running at reasonably high levels there. So in India, we're talking levels around 9%, in China around 5%, and it's quite difficult really to get a real handle on those numbers. But nonetheless, at some point they too need to potentially start slowing their economies down. And then one might question some of the growth there. It's someone mentioned it's a bit of growth on steroids, for example. So in China you have a huge amount of growth and it's going into infrastructure and so forth, but you're also starting to see some of this filter back into their banking system as potential bad debts. So it's not without worry. From a global perspective, and this will take time, what will be a source of comfort is if you start to see the Chinese consumer start to be a bigger player in the Chinese economy and the world, and start to maybe level out some of the trade imbalances that are going on globally.
Because for now we cannot discount the fact that the US, Europe plays an important role in that regard in fueling the growth at this stage where it's so export driven. So if these economies don't start ticking, then you've got the likes of India, you've got the likes of China that surely can't grow on their own.
They can't grow on their own. To some degree, China has a balance sheet so it can plow funds back into its economy, which it does do, of course. But it brings the question of what type of economic growth is it? Is it another road? Is it another building? And what's the purpose ultimately? It's different if the consumer were to take its position in China and become a greater portion of the global economic scenario.
Let's take a look at the US, because consensus seems to be that common sense will have to prevail, that agreement will be struck on having to raise that debt ceiling, and stimulus will emerge in some form or another. Are you in line with consensus?
Yeah, it's kind of saying agreement must be met, but bear in mind they're going through this 100% mark. So, we're agreeing to get a little bit worse. And all we're saying back in the office is at some stage the USA is going to have to go through the process that Europe is going through. It's going to have to go through the austerity measures. They have their own difficult dynamics because at one stage, they would argue let's lift the debt ceiling, but then potentially let's raise taxes, and the other party will say no, that's not in our thinking, and so forth. So they're in this tug of war, and I think they're going to hold it out pretty much to the last moment, and then someone will buckle and they'll get through it, because the consequence of not getting through it, you cannot at this point in time with the globe having a dollar under threat. So I think ultimately they will reach agreement, and they're just trying to push for the last minute and get maximum leverage.
So while you've got playing out there, you've got austerity being put into full steam over in the Eurozone. You've got concerns about whether Chinese and Indian growth is sustainable or not from an investment perspective. How do you make sense of this entire scenario?
And just the last thing to add to that little pot of a mess is on the currency side. We would potentially have the view, part of the escape route for the USA is to let the dollar weaken so that they can gain on an export point of view, and allow the Chinese currency to strengthen. And you've seen a bit of noises around this space, but that's bringing its own difficult dynamics to the equation. Of course, won't suit Europe. Because they too need economic growth. And Europe's in a very tricky position, the beneficiary being Germany, of course, because if you look at Europe, about 40% of their exports are within the Eurozone, and the Spanish and the Greeks and the Portuguese don't have an ability to deleverage their currency versus that, and are unable to get a competitive advantage relative to Germany. So you've got so many dynamics, and most of them, what we have spoken about, are a little negative actually.
Absolutely.
Except maybe that the Chinese consumer plays a bigger part going forward. And that's a long-term trend, of course, but certainly will play a part going forward. And you've seen it with motor vehicle sales. So it's not all doom and gloom, but there's a good reason to be cautious out there. And that's probably our first positioning, is to becoming a little cautious. To some degree, comfortable with the South African environment. And even the South African growth rate might be a little bit less by the time we reach year end than might have been hoped for whilst we started this year. But nonetheless, there's still a number of companies that are probably well positioned. So there are certain sectors that are strong in their cash flow generation, and that should be supported.
Oh, so you'd be taking then more a defensive stance if you are staying in South Africa?
Yeah, in equities, more defensive at this point of time. Unless we're trying to, as we would suggest, ride a bit of a tailwind out of the resource sector. Now you'll see Bulletin will come through. Earnings will be, on a year ago, 50% up, or even a little stronger than that. So in our mind, there's still a bit of run left in that story, but the more defensive, stronger stories, things like, let's say, the cell phone companies, Vodacom and MTN, are very strong on their cash flow. They have an ability to pay out dividends. That's something that can hold a capital value together, relatively speaking, in the event that markets were to come off.
Yeah. If you do want that offshore exposure, though, do you do it via, exposure to companies listed in the US, listed in Europe, that have that emerging market focus, or do you stick to players that are listed locally with that emerging market footprint?
It's a combination. So to some degree, in the South African context, you will take a company like British American Tobacco or even South African breweries, which is a higher valuation level. British American Tobacco, and I saw today they're buying back their own shares, so there's another source of comfort. But you have a really strong dividend yield there in a hard currency, in a sterling, and it in itself is exposed to some of these high growth regions, China, for example, and of course South African brewery is very strong in South America and so forth. So a Western world based company, but has tentacles out into these strong economies, which should play well. And once again, if you go internationally and you're stock picking on an international basis, our filter mechanism for our international equity portfolios is pretty much stocks with a high dividend yield, which implies to some degree a high cash flow, but also that some of their operations are based on international emerging markets. So for example, when you look at a company like Nestle, it really is a global company. So you have quite a nice balance and not just restricted to those portions of Europe and the USA. But when you do speak of these global companies, I mean, I should warn that a large chunk of their earnings is still based from Europe and the USA. You can't really get away from that.